In this brief video, I'm going to simply clarify some of the terminology that is used in floating rate deals. When we offer private credit investments, we generally offer them specified as either a fixed rate deal or specified as a floating rate deal. In the fixed rate transactions, it's pretty straightforward. Investors know they're receiving a fixed rate of return per annum paid according to the payment schedule. That's generally monthly or quarterly, depending on the actual deal. When we do floating rate deals, however, we use the term BBSW. So I thought it was just worth running through this terminology in this video. As we often get asked, what is 1M BBSW, or perhaps what is 3M BBSW, and why is BBSW being used? Now, 1M simply stands for 1 month BBSW, or 3M will stand for 3 month BBSW. And what is it? What is BBSW and why is it being used? In answering that, BBSW stands for the Bank Bill Swap Reference Rate. It's essentially the short-term floating rate benchmark of the financial markets, which is used to determine where short-term rates are from 1 month out to 6 months, and it's set on a daily basis. It is calculated and published by the ASX, the Australian Stock Exchange, and they do this by averaging the rates at which the bank bills are currently being traded between the prime banks in Australia at each of those monthly maturities out to the 6 months. So essentially, this is where the banks will lend to each other for each of those short terms, that is from 1 month out to 6 months. This means from a credit risk perspective, it actually reflects short-term lending for major bank credit risks. So in a rising interest rate environment, you would expect the 3-month BBSW to set slightly higher than the 1 month to reflect any potential pricing in of the chances of a rate increase within the 2-month period between those two rates. So when the RBA announces a rate increase, they are essentially changing the official cash rate, which is the overnight rate set or the one-day rates. Whereas when we look at 1 month BBSW, it reflects the 1 month lending rates between the major banks. So if interest rates continue to go upwards, you would expect BBSW to be moving higher up until the market expectations may start to change, whereby the market may start to take a more negative view on future rate movements. Then you would expect BBSW rate sets to start to fall. Now, if I bring all this back to our floating rate private credit deals, BBSW is used given it is the floating rate benchmark of the financial markets. If a private credit deal is being shown as paying a set margin above BBSW, the reference to that floating rate benchmark being BBSW tells you that it is a floating rate deal, whereby each monthly or quarterly payment will vary as they are set off the BBSW at the start of that particular month or that particular quarter. So for example, a deal paying 1 month BBSW plus 5% will mean you are receiving the 1 month BBSW rate set from the start of that month plus the set 5% margin. The floating rate component of this deal is the BBSW referencing each month, whereas the set margin above BBSW is essentially locked in for the full term of the deal. I hope this has really helped in just clarifying some of that terminology that is used in floating rate private credit deals. Thanks.